Well, good afternoon. It's quite an honor to be here at the Energy Seminar. It's an unfortunate situation that has me in front of the room. Nonetheless, thank you very much for the honor. I've spent about a year and a half working with Stefan Reichelstein, understanding the solar market. And today I'd like to go through 3 different questions related to the solar market. Before I do that, it'll be important to distinguish between 2 different industries. The solar market can be nicely segmented into both the downstream side and the upstream side. And one of the things that has happened over the past couple of years is that the mood on the downstream side has been relatively upbeat, while that on the upstream side has been relatively downbeat. And some of the numbers on this slide start telling that story. On the top, we see the story on the downstream side where solar PV, though accounting for a relatively small share of generation here in the United States, has experienced absolutely rapid growth globally. The installations in the United States have also been growing rapidly, and the figures here really highlight that story. In 2013 alone, we've seen 40 gigawatts of solar power generation capacity come online. And that figure, 40 gigawatts, is equal to the entire cumulative installed installations of solar from the 1970s, when solar was first being applied in terrestrial applications, to 2010. So this is a tremendous growth that we see in just 1 year, what's happened from the 1970s all the way to 2010. And what that's implied is that by 2013, the total global installations of solar PV have reached just about 150 gigawatts. And so we see solar developers, such as Solar City, headquartered just up the highway, doing quite well because of this. On the flip side, and actually before I get to the flip side, we should say that part of the explanation for why the downstream side has been doing so well is that prices have been declining quite dramatically. So if we now shift our focus to the downstream side, to the upstream side, we see that solar panel prices have dropped dramatically. In fact, it's been an 80% drop from 2008 to 2012. And this can be explained by a couple of factors. There have been massive additions to global PV manufacturing capacity. A lot of Chinese firms have started manufacturing and ramped up their manufacturing over the last couple of years. But by all common financial metrics, these module manufacturers have been bleeding financially. Though the situation has started to change, there were issues with respect to the recession and also with respect to the easing of subsidies, especially in Europe, that led to some of the financial issues with solar PV module manufacturers. So now on to those 3 questions that I've promised. The first is electric power generated by solar PV technology currently cost competitive with that from fossil fuels? And in answering this question, it'll be important to make 2 distinctions. One is with respect to the technology, and here we can talk about both crystalline solar PV technology and thin film solar PV technology. We can also talk about the scale, and here I'll distinguish between the utility scale, which refers mostly to projects of 1 megawatt in capacity and higher, and also the commercial scale. And here you can imagine companies such as REI or Walmart thinking about putting solar panels on their rooftop. The second question is, which factors in the cost competitiveness calculation are most critical to determining whether solar PV is truly cost competitive with respect to alternative technologies? Finally, given that we've noticed such dramatic price reductions, can we simply take those prices and project forward and say, look, prices are low, therefore prices will continue to get lower, and use that as an expectation of how competitive solar will be over the next couple of years? Now, one of the reasons we care about this is a sub-question at the very bottom. The Department of Energy has something called the Sunshot Initiative, where they would like to, or the goal they have expressed, is that solar PV should have a cost structure such that a $0.5 per watt figure would be enough to cover the manufacturing costs faced by module manufacturers. What does it mean, though, to be cost competitive? When we talk about electricity generated by solar PV, we have to think about the alternatives in that space. And that's going to include generation from fossil fuel technologies such as that from coal, natural gas, and to a lesser degree here in the United States, oil. Because of that comparison, we often hear statements such as it stands, electricity from solar PV is not cost competitive. It's X times as expensive to get it from solar as it would be to get it from coal. And a fundamental challenge in all of this is that when we think about solar on the one hand and fossil fuel generation on the other hand, these types of technologies have very different cost structures. In particular, if we think about 3 different contributors driving the cost competitiveness, we can look at upfront capital expenditures, the periodic operating costs, and the applicable tax rules and subsidies that apply in all these industries. Now, when I talk about fossil fuel industries, you can imagine that because there are ongoing costs of purchasing the coal or the gas or the oil, that a significant contributor to cost competitiveness will be that middle bullet, the periodic operating costs. But the situation is different when we think about solar PV, where actually those operating costs are very low, and the bulk of the cost structure is concentrated in the upfront capital expenditure. So what do? We come up with a common cost metric called the levelized cost of electricity. The advantage of the levelized cost of electricity is summarized in text, and I'll read this out and then offer a summary. The levelized cost of electricity is the constant dollar electricity price that would be required over the life of the plant to cover all operating expenses, payment of debt, and accrued interest on initial project expenses, and the payment of an acceptable return to investors. And so what we have implied here is that there is some average price that a facility would have to receive on every kilowatt hour of output that would then imply that that project would break even. It wouldn't make a profit. It also would not be economically unprofitable. It would just break even. And that's what the bottom bullet point summarizes. The LCOE is a break-even sales price needed to justify an investment in a particular technology, in a particular generation facility. As we define the LCOE, we can decompose it into 3 different components. And those 3 different components are at the top of the slide. In particular, there's a term that covers the variable costs, that's W, the fixed costs, F, and then one combined term that has to do with both the unit cost of capacity and what we call a tax factor. And the tax factor is going to summarize all the implications of corporate income tax on the cash flows to a particular investor in an electricity generating facility. Now, income taxes will affect the situation in a couple of ways, right? It will imply quite directly that there are tax liabilities to the investor, but it also implies, given the accounting rules, that there are things called a depreciation tax shield and also something called a debt tax shield. Subsidies, therefore, when they operate at the tax level, have quite an impact to influence the importance of the capacity costs, because they affect delta, the tax factor. In all of this, given that the LCOE is a constant price that would imply that a project would just break even, it ties very closely with traditional corporate finance metrics, such as the net present value. And if we want to find a metric that then implies a break even, then the LCOE must imply that the NPV of all operating cash flows after tax is exactly 0. And so that's the measure that we'll apply to compare the electricity generated by solar to that generated by traditional fossil fuel plants. So in going through this exercise, in understanding what exactly is the levelized cost of electricity from solar, I'll be using best case scenario parameters. And when I say best case, I don't mean to imply that these are unrealistic. They've all been observed in the market. Nonetheless, they're best case in a couple of ways that I'll highlight here. So if I can focus your attention on the leftmost column, where we have utility silicon, there are 2 or 3 parameters in particular that imply these are best case. For example, the module price of 70 cents per watt, until recently, until perhaps the last year or 2, had seemed like something that would be best in case. But in fact, we're observing that more and more often. A second thing to point out is this capacity factor of 19.9%. And as I'll explain later, this assumes that the project we're assessing is in a location with a really good solar insolation, that is, a really good solar resource. Finally, I'll briefly comment on the discount rate we use. You'll see here it's 7.5%. This reflects a weighted average cost of capital. The cost of equity that the project would face would actually be higher in the 10 to 12% range. And that cost of equity would depend on, the weighted average cost of capital would depend on the amount of debt that the investor has taken on. So let's look then at what does this imply for the levelized cost of electricity. The top of this slide first has a lot of numbers, but second, it includes all the stuff that I've already showed you. So let's ignore that for a second and go to the bottom of the slide, which is labeled the LCOE calculation. And here I'd like to make 3 points. At the very bottom of the slide here, levelized cost of electricity, we can immediately see that for this particular application, which is for a commercial scale solar installation, the levelized cost of electricity is estimated at 10.3 cents per kilowatt hour. The second thing to point out is, as I said before, the variable costs associated with this project are zero, virtually zero. The third thing to point out is that the bulk then of this cost, this levelized cost of electricity, comes from these two lines. And the first is that unit capacity cost. As with many other renewable technologies, solar electricity generation involves a large capital outlay and not many costs over the lifetime. What then is important is this tax factor, because it's the product of this term and that term that essentially implies a levelized cost of electricity. And so any subsidies or any incentives within the tax structure that can change this level will have a very direct impact on the levelized cost of electricity. Now, I've shown this for one application in that slide, and that is for what's shown here in the top right, the commercial scale silicon application. And there we see that it's 10.3 cents per kilowatt hour. When we look at utility scale silicon, the LCOE is 7.3 cents per kilowatt hour. And then on the bottom row, we see the same numbers for thin film, rather the same scenarios for utility scale, commercial scale, but with thin film technology. And directionally, these make sense. So once we go from commercial scale to utility scale, we're losing some of the scale effects of an installation. It's harder to optimize the modules that you lay down in order to maximize the capacity factor. You may be more prone to having shading on those commercial scale installations. Thin film LCOE generally ends up being a bit higher because the balance of systems costs generally are higher for thin film applications. And that's a result of the fact that for a given level of power generation, thin film generally requires a larger footprint, a larger physical footprint. And therefore, these results make directional sense. But what do we do with that? Now we need to make that comparison. We need to understand, does this LCOE calculation imply that solar is competitive or not? So at the very top, we'll look at commercial scale PV. And here our assertion is that actually commercial scale PV in favorable locations is already cost competitive. Especially when we think about places like California, where for a commercial scale entity, prices are quite high. So in Southern California, the average commercial retail rates are around 12 to 14 cents per kilowatt hour. And you can compare that right away to the 10.3 that we've estimated for commercial scale silicon. On the utility side, however, the picture is slightly different in that we estimate that solar PV in the utility scale is still about 10% more expensive than that generated with natural gas. And our estimations show that the LCOE for natural gas is about 6.6 cents per kilowatt hour, and that assumes a delivered cost of about $6 per MMBTU of natural gas. But there are some things that can boost the competitiveness of solar PV on the utility side. In particular, a lot of states have what are known as renewable portfolio standards, and that can give an additional boost to utility scale installations, in that there is something known as a renewable energy certificate that then allows an additional source of revenue to make solar PV installations more cost competitive. when a project developer adds trackers, that can additionally make solar PV installations more competitive. So our calculations suggest that the use of trackers can reduce the levelized cost of electricity by up to 20%. And a final thing to take away from this, from question one, or our answer to question one, is that silicon crystalline and thin film are still running neck to neck. Though silicon crystalline accounts for the lion's share of the market today, it is not as though we can simply say, well, thin film is completely uncompetitive. Within a couple of years, we should expect it to exit the scene. I think it's still a little too early to come to that conclusion. So let's jump to question two. What impacts the levelized cost of electricity? To what exactly is it more sensitive? And just by showing a map, I think I've alluded right away to one of the more important drivers of cost competitiveness of solar photovoltaic electricity. Location is a huge driver. What we're seeing on this map are the effective hours of sunshine per year in different locations around the United States. So there are 8,760 hours per year, and what this map is showing with these numbers is the number of hours per year that a solar facility could actually generate solar power. And because capacity factor is roughly proportional to the insulation factor, this will end up having an impact on the levelized cost of electricity that we measure for different facilities across the United States. On this graph, we'll look at a number of different factors and their impact on the levelized cost of electricity. So to orient you, on the x-axis we show the percent change in different input variables. So it will be, in certain situations, a capacity factor, in other situations, a tax rate, and on the y-axis, the change in the levelized cost of electricity. The percent change, I should say, in the levelized cost of electricity. So if you focus your attention on this line here, we see the impact, the very large impact actually, that the capacity factor has on the levelized cost of electricity. In particular, if we were to cut the capacity factor in half, we'd effectively double the LCOE. And this has a major implication for the deployment of solar photovoltaic electricity in northern regions. So we can imagine places like Germany with lower insolation levels than the southwest United States certainly, or even in New Jersey where there is also quite a push towards solar PV. The implication is that because the capacity factor has such an effect on the LCOE, that certainly will have different implications, or that certainly implies different implications for different locations. Now, there are two other comments I want to make with respect to the sensitivity. One pertains to this green line here, and that refers to the DC system price, or just put more simply, the upfront cost that a project developer must pay in order to install a solar facility. And so given that the LCOE is primarily driven by that upfront cost, it's unsurprising that we see a pretty sharp sensitivity here to that upfront cost. The last thing to mention has to do with the tax rate sensitivity. And so if you focus on this line right here, which is nearly horizontal, you'll see an almost surprising lack of sensitivity to the tax rate. And that is an effect really of the tax subsidies that apply to the solar sector. If we were to remove those, and I'll get into what those are in a second, if I were to remove those, then we'd see actually quite a larger degree of sensitivity to the tax rate itself. But there's an additional wrinkle in calculating the levelized cost of electricity. And that is that we haven't considered the fact that across the hours of the day and across the seasons of the year, there's actually quite considerable variation in when solar power is generated and also in how valuable it is. So it's not the same thing for a solar panel to produce electricity right now as at 3 a.m. in the morning. We simply value electricity differently based on the time of day. So the calculation that we've shown for the levelized cost of electricity is appropriate when either of those things are held constant. So if either the facility were generating power at the same rate at any time of day, or if the value to society of that power were constant over the time of the day, we'd have no further adjustments to make to the levelized cost of electricity. And that's the case when we think about dispatchable sources of electricity. Fossil fuel generation, such as that from coal or natural gas, fits that profile. of having a dispatchable structure and having a generation profile that is similar across all times. That's not the case, of course, for solar, and it's also not the case in many settings that the value attached to a unit of output of electricity is the same across the time of day. So the punchline here is that the basic levelized cost of electricity that I have delivered does not capture any economic value added or any economic value lost because of an overlap or lack thereof of the pattern of power generation or the price of the electricity. So let's see how we can deal with that. But before we do that, I'll show an example of where this actually is important. So what we're seeing here is a generation pattern in San Francisco for a 1 kilowatt installation. On the x-axis here, you're seeing the time of the day, and on the y-axis, the power generation. And there are a couple of things that we can note right away. First, the dark line here refers to the mean level of power generation over the course of the day. And what's noticeable is that the highest productivity is between 10 a.m. and 5 p.m. And especially noticeable is the fact that the peak generation is more than 3 times the average generation. So then the question is, to what degree does this overlap with the value of electricity? If we consider a commercial customer, then this is the price that commercial customer would face in the summer. And this is a small-scale commercial customer in Northern California. So this is a customer of, for example, PG&E. And what's noticeable here, actually let me orient the graph first. On the x-axis, again, we see the time of the day. On the y, the price in dollars per kilowatt hour. And again, that black line, that black horizontal line provides the mean level. And what we can see is a spike in the retail price to 44 cents per kilowatt hour during these summer peak demand periods. So what do we do with the LCOEs? What Stefan and I propose doing is adjusting it with what we've called the covariation coefficient. And the covariation coefficient allows us to still use the LCOE as it's been calculated many times before, but to adjust it with a simple multiplicative factor that adjusts for this level of overlap between power generation and the time of the day. And a nice feature of this covariation coefficient is that it equals 1 if either of the simplifying assumptions are met. That is, if power prices are uniform, or if the facility is generating at a uniform rate across all time. And so that would be the case for a dispatchable energy source for a fossil fuel generator, and therefore there would be no adjustment necessary there. It'd be for these intermittent style technologies, for renewables, that this adjustment would have to be made. And so the application I shared for small commercial customers in the San Francisco area, the covariation coefficient equals 1.17, and the implication of that is that then the LCOE would be reduced by about 15%. So this is a first order effect. We looked at some of the sensitivities. We saw that a change, for example, in the tax rate, given subsidies, wouldn't make that big of a difference. But we see that actually accounting for this level of overlap does make about a 15% difference. Now, I also promised that I would explain what those federal tax subsidies are. And there are two prominent tax subsidies that currently apply to solar generation. One is the investment tax credit, and the other is the accelerated tax depreciation allowance. And what we see in the middle of the slide here are 4 cells that summarize the impact of these two tax subsidies. So in the upper left-hand corner, you'll see that 10.3 cent per kilowatt hour figure that I've been saying a couple of times today. This is a figure that emerges if we have both that accelerated depreciation and the investment tax credit. Now, if you look at the bottom right cell, which assumes that neither exists, you'll see that there's quite a dramatic increase in the levelized cost of electricity. So this is a jump of 7.5 cents. And if you can remember that spreadsheet that I showed with the delta factor, that delta itself, the tax factor, will jump from 0.7 to 1.3. And because that delta factor is scaling the capacity cost associated with these solar installations, it has quite a tremendous impact on the levelized cost of electricity. Now, the tax rules beyond 2017 imply that we won't be going from a 30% ITC to a 0% setting. We'll actually go to a 10% ITC with the accelerated depreciation still in place. So the implication would be that the LCOE would increase from 10.3 to 13.7 cents per kilowatt hour. But in sharing all of this, I've still assumed that the solar module prices would be 70 cents per watt, and that's what I started off with. Do we believe that that's going to be the case in 2017 or any other close year? Now, in this very room, I think about 2 years ago or just over 2 years ago, Dick Swanson, who is on the Stanford faculty and also affiliated with SunPower, shared the graph that I've reproduced on this slide. And this graph suggests that every time the cumulative volume of modules produced doubles, that prices will fall by 20%. So to orient you with this graph, on the x-axis, we're looking at the cumulative level of production over all time, and on the y-axis, the module price in 2010 dollars. What's been really remarkable about this trend is that over time, prices have adhered pretty closely to this curve. And so one thing we could do is to say, okay, over the next couple of years, this is an immutable law, this is Swanson's Law, and therefore, over time, we might expect 20% reductions to happen. But what has happened over the last 3 years? We've seen, and again, the graph is similar to what I've just shown. On the x-axis, we see cumulative output, and on the y, the average sales price, or ASP for modules. We've seen a large increase in installations. In 2011, there were 28 gigawatts of installations. In 2012, 30, and just last year, 39 gigawatts. So installations certainly have continued. There's some expectation then that prices would have also decreased. Now, the red curve here shows the Swanson curve, and this is a learning curve that says with every doubling of output, we should see this 20% reduction in prices. What it also shows in blue are the average sales prices that actually have been observed. And what is notable as we go towards the right part of the graph is that these prices are quite far below the 80% learning curve. So the question that arises is, do these prices reflect the fact that demand grew, that there were cost reductions in the fundamental structure relevant to module manufacturers, or does it imply that there were simply excessive additions to production capacity and that we can't take these prices as truly reflective of the underlying cost structure to firms? To answer that question, we need to come up with a measure that says what would we have observed had everything been completely explainable by true reductions in costs. And our definition of that concept is the economically sustainable price. Now, the economically sustainable price is exactly analogous to the levelized cost of electricity that I shared earlier. And that is that it is a break-even price that manufacturers would need to charge to just break even, to cover their costs and receive a normal return on investment. So if you think back to some of your economics classes, there is a notion that marginal cost equals price. And though I'm calling this an economically sustainable module price, this is a reflection of the cost structure of the firm. And in our theory, in our modeling work, we have a concept of a long-run marginal cost that is able to decline over time. And when you have a market structure that is competitive, when you have a competitive equilibrium emerge, our prediction is then that the price will be equal to this economically sustainable module price, which we can think of as a cost measure. What's included in these prices, or rather I should say costs, sorry for using those words interchangeably, are capacity-related costs. That is, what does it take to actually set up a facility and produce modules? It includes the manufacturing costs, so what is it going to cost to purchase the polysilicon, the aluminum, the silver, etc., that have to go into module production. And finally, it includes period costs, so that is sales, goods, and administrative or R&D costs that the module manufacturer will face. What we do is we analyze sample data from 11 module manufacturers from 2008 to 2012. This represents a collective market share of about 25%. And using a simple flow balance of when shipments of solar modules were realized and reported, We can then infer product costs, we can infer production levels and shipments from these financial statements, and then derive a measure of what the economically sustainable price was. So on this graph, we can see an update to the graph I shared just 2 slides ago. In particular, the green line shows the economically sustainable prices that we've estimated from the first quarter of 2008 to the fourth quarter of 2012. And there are 3 things that I want to point out here. The first is that between 2008 and 2010, the match between economically sustainable prices and the average sales prices observed was actually quite good. The second thing is not only the prices themselves, but also the derivative, the slope of the prices themselves, matched fairly closely. The third thing is that there's a widening gap between 2011 and 2012. And when we look at that green curve from 2011 to 2012, there are 2 further things that we can say. One is that cost reductions, rather that the ESP suggests that there are cost reductions greater than what would have been implied by the Swanson curve. So we can see that the Swanson curve, that experience curve in red, would have predicted price reductions and cost reductions at the red level. But we're actually seeing in our data reductions beyond that. The second thing is that there is still, despite those cost reductions, a gap between the ESP and the ASP. So when we have this motivating question about do these prices reflect true cost reductions or do they reflect excess capacity, the answer is yes, they reflect both. There's a little bit of both going on here. Now, there are 2 implications of this. Module manufacturing and module trade has been at the center of a lot of international trade discussions. And one of the questions of interest is what can we say with respect to what prices should have been observed and what prices would have implied that manufacturers were actually dumping modules in the United States or in Europe. Now, to the degree that dumping is defined as selling below your average marginal cost, our ESPs suggest that the short-run avoidable cost, which relates to the current manufacturing costs, are about 70 cents per watt. A recent deal between China and Europe suggested that a minimum sales price of 74 cents per watt would apply to modules manufactured in China. And so there is a good match between what we estimate from the data and also the negotiated agreement between China and the European Union. The second is that this analysis of firm-level data allows us to look at to estimate learning rates for both manufacturing and capacity costs, and then to form a perspective about where our costs going to go going forward, and on that basis, given our assumption about a market in equilibrium, where prices will move going forward. Here again is that same graph we've been looking at, and what I've added to this is this gray line going from Q4 2012 down to 2018. And one implication that I want to point out right while we're looking at the graph is that the sunshot goal would call for a price at 0.5 per watt. And if we go out to 2018, our estimates do not suggest that that is going to happen sort of without any additional technological breakthroughs. In presenting this, I should say 2 things. One, this is preliminary in the sense that we are adding data to the panel so that what we actually observe, the precision of our estimates will be improved as we add more firms to the panel. The second thing is that this should be, in many cases, interpreted as a best-case scenario. And the reason for that is that one of the inputs in module manufacturing is polysilicon. And as we look at the polysilicon prices over the last couple of years, we can see that polysilicon prices are actually at some of the lowest levels they've been at. And what this might indicate is that upstream industry itself may be out of equilibrium. Once you account for that, the learning rate that is implied by this curve would appear to be too aggressive. And so then the learning would actually, the implied prices in each of these years would be higher. If you were to assume that over the next couple of years, that polysilicon market itself will come back to equilibrium, the prices there will increase, and therefore this line would not decline quite as sharply as we show on this graph. But to summarize some of the takeaways from that graph, we remember that the ESPs represent economic fundamentals and assume that an industry equilibrium is in place. That is, that the prices that we observe actually reflect the true cost structure of manufacturing. Based on our forecast of cost reductions, we've estimated a 75% learning curve. Now that is more aggressive than what Dick Swanson would have presented here a couple of years ago. That is more aggressive than the 80% learning curve. And the reason that we have a more aggressive learning curve is that we suggest that there is not just cumulative production volume as a driver of learning, but also calendar time itself. And it's not that costs are going to decrease just because time is increasing, but that in the meantime, what is happening upstream of the solar sector are innovations in the production equipment used to manufacture modules itself. Now, we'd expect that there would be a convergence between the ESPs and ASPs in coming years, and to stop using those acronyms between the economically sustainable price and the average sales prices. The reason for that is that we'd expect the market to return to equilibrium levels. But importantly, the average sales prices would not exceed the economically sustainable prices. And new capacity additions are unlikely until those average sales prices are on track, in some sense, to catch up with those economically sustainable prices. Now, how quickly will we get there remains a bit of a mystery. What we can say is that that is linked to the trajectory by which new capacity additions come online. In turn, those new capacity additions depend on the trajectory of demand in the solar sector, and that itself will depend on the level of public subsidies. As we saw, there's quite a dependence on federal tax subsidies in the cost competitiveness of solar. That itself will link to demand, and that itself will link to how quickly we come down this ESP curve. So to summarize what we've gone through, there are three questions that I opened with in the presentation. The first was, are solar PV facilities cost competitive? The second, to what degree do they depend on the factors that we assume? And third, what can we say about prices going forward? When we look at downstream, we've concluded that in favorable US locations, commercial scale solar PV is already cost competitive. On the utility side, however, solar PV is still 10% above the generation cost of natural gas. Of course, both of these findings require the rate of federal subsidies that we've assumed, and also an ideal geographic location. On the upstream side, we've indeed seen these dramatic price reductions, but we'd suggest that they're in large part due to excess module manufacturing capacity. At the same time, they also reflect true cost reductions that have occurred over the last couple of years, and they appear to be more favorable than what the Swanson curve would have implied itself. In saying all that, I should say that we are not interested in saying the Swanson curve isn't right. It's simply that if we have observed a set of prices, it's of interest to understand if we've diverged and see evidence of even quicker learning than the Swanson curve would have itself predicted, or for that matter, even slower learning. The implication is that the economically sustainable price is still near 0.9 cents per watt, or dollars per watt in 2013. And so this differs from the prices that we're seeing and that are frequently offered of about 60 to 70 cents per watt. And for the next 5 years, we'd predict that the average sales prices will be distinctly below that 80% learning trend line. And one of the reasons is that we've already observed certain cost reductions. We don't expect that those cost reductions would be reversed. But without faster growth in market demand than what we assumed in coming up with the projections, the goal of 50 cents per watt for modules by 2017 looks to be out of reach. The gap that we estimate will exist in 2017 would be about 15 cents per watt. So with that, I'll close. Thank you very much for your attention, and I'll be happy to take any questions you have.
Okay, are there any questions?
I understand that balance systems costs are pretty significant overall, and I wonder if you looked at projecting those costs.
We haven't looked at projecting those costs, and I think that you're absolutely right, that's going to be a big driver of how competitive solar is over the next couple of years. Some of the interesting trends I can point to, Well, actually, I'll back up and say that the DOE also has a goal that the entire system should come to $1 per watt by 2017. And so if we're estimating that the module itself won't go to 50 cents, that implies that the reductions in balance of systems excuse me, would have to be even more dramatic than expected. There's some evidence that so-called soft costs, that is permitting costs, et cetera, could be decreased. And so analysts have pointed out to the divergence between the US experience and the German experience as a space where as evidence that those costs could actually come down. There's also some interesting work coming out of the LBJ school at University of Texas that is looking at how balance of systems costs are, rather how patenting activity in balance of systems have trended as installations have increased. And so this could start to give us a sense of, are there possible reductions in balance of systems as you install more systems?
Okay, I'd like to particularly encourage questions from students.
Hi. I'd like to know if there's, when would you think we could reach an ESP that makes solar photovoltaic energy competitive towards oil?
So by towards oil, I'm assuming you mean electricity generation from oil, yeah.
Exactly.
Yeah. So I think that, so there, it'll first depend on whether you're in a market that subsidizes oil quite heavily, but let's assume that that's not the case. If you're in a market like here in the United States, oil is generally a marginal contributor to electricity generation. And so on that basis, it's really the comparison to natural gas, I think, is much more meaningful, because we'd like to see when is solar going to be competitive with a generation technology that is increasingly providing baseload, right? And so that I think is a more interesting comparison. With respect to oil, in many cases, given how close solar PV is to cost competitiveness with natural gas, I would say it may already be there. I haven't looked at those numbers, but directionally I would expect that it would be there.
A lot of the utilities are increasingly concerned about distributed generation. When you look at the utility costs that you showed versus the cost of distributed generation, assuming that the lower upfront capital has a big impact there, what do those comparisons look like?
So just to make sure I understood your question, there's going to be increasing distributed generation, and therefore, well, so I'll walk through the mechanics here. So if there's increasing distributed generation, the price charged by retail at the retail level may increase from PG&E, et cetera. There are two things that would happen, though, right? On the one hand, you'd see an increase in prices at the retail level. You'd also see, as distributed generation comes online, that the value of grid electricity during those periods would actually decrease. So which of those two effects would dominate, I think, is still an open question, right? And so when you think about this covariation coefficient that we've defined, that it looks at the match between power generation and pricing, it's the implication on pricing that is an open question, and there are two effects that are going to happen. And so I can't, I wish I could answer exactly that question, but that's something that's still open.
What kind of improvements in efficiencies are incorporated into the ESP sort of pricing model? I mean, Dick Swanson himself and his company anyway just announced that they're anticipating higher than expected efficiency increases within the next few years. So.
Sure. So I'll offer two answers. On the one hand, if we account for efficiency itself, physical efficiency, and we look simply at the dollar per square meter of module produced, then we see a learning rate that is 2 percentage points higher. And so that implies that there truly has been this gain in efficiency, and that's already baked into the ESPs. The second answer is the ESP trend that we have here assumes that there will be a similar increase in efficiency over time. Now, if SunPower or any other company for that matter suggests that they have higher than average improvements in efficiency, really the question that I'd be interested in understanding or answering is, how quickly will that actually be incorporated into the mainstream manufacturing line? So one thing I've seen reported quite often is that there is a lag between when efficiency comes out and when that then is incorporated into manufacturing. So, but you're absolutely right in pointing out that these estimates they implicitly assume that the same type of efficiency gains that we've observed from 2008 to 2012 will continue going forward.
When you have a significant production from solar, more perhaps like in Spain or in Germany, don't you think that you also need to take into consideration the upfront cost of the gas plant itself? Because you still need to use the gas plant anyway.
I think one of the things you're referring to is that as an increasing share of renewable or intermittent generation comes online, they also imply additional ancillary services that need to be added. And so when I suggested in part of the slides that we've accounted for intermittency and the time of day effects, I certainly didn't account for that. You're absolutely right that is in some sense a cost penalty to solar and to intermittent facilities.
National Renewable Energy Labs several months ago said that like 6 hours of storage for a thermal plant would be worth 3.85 cents per kilowatt hour in additional value to the utility solely because of time shifting and deferred equipment, not even looking at the fact that that can be the stable, the load conditioning factor. So and the other thing is that I heard not one word from you the entire lecture about externalities from fossil fuels.
Sure.
About crashing the planet from global warming, about any kind of value from that. Now there is a risk analysis study that's been started. It's called Risky Business. And so have you got any information from your part where you would say, okay, so the risk to the economy from not changing from global warming, we attach this many cents per kilowatt hour to the levelized cost of fossil fuel generated energy, and we put that up against, have you done anything that does that?
Well, if you assume that there's a social cost of carbon dioxide, certainly you would want to include that, and to come up with then a levelized cost of electricity that incorporates the externalities that so far haven't been priced. Now, you do that relative to a baseline level, and you'd account for that in your levelized cost. I don't have a number. And the probabilistic analysis that you suggested, which is there's some chance of climate effects, that is actually something that we have incorporated into the levelized cost framework. No, I haven't presented it here. You're absolutely right. I haven't done that. But some of the work that we are doing says, or rather accounts for a levelized cost measure that needs to account for uncertainty, that needs to account for what we call managerial flexibility, for the fact that in different states of the world you may want to do different things. And so I think you're hitting on an important point. It's not something we've incorporated, but certainly there are external costs to the degree that, now let me back up and say, why haven't we included them here? If solar facilities are right now competing against a natural gas plant that doesn't currently face a price of carbon, then when we want this measure of cost competitiveness, we can't already add on that social cost of carbon dioxide or any other greenhouse gas emissions.
But in terms of policy formation, we could.
You could.
And the corollary to that is, so when the cost of batteries goes down to 1 to 3 cents per kilowatt hour levelized cost,
Yep.
and actually within about 5 years or 7 years, it should be down below 0.9 cents per kilowatt hour. What does that do to your curve matching, the thing that you did?
If battery prices go down as steeply as that, I mean, certainly you can think about incorporating it into this framework quite easily. So one thing is, we've had a question over here about what do we have to do with respect to ancillary services. If we have battery technology that is cost competitive, you can get an upper bound then on what is it going to cost to actually from a network perspective, install solar PV technologies. And the way that one could do this is the following. You take the battery requirement, you'd add it then to the solar PV cost structure, and you'd say, in order for this solar PV facility to appear to the system operator as a dispatchable technology, I'd have just as much battery technology. That, I would say, is an upper bound, because certainly there are other ways to balance out the intermittency.
So at some point you mentioned the levelized cost of electricity without some incentives, basically.
Yes, sir.
And it went from 10 to like 17.
Yep.
So is the 17 the number that's like a clean number without any subsidies, basically? Or like, what I'm trying to get to is, what's the number if you take out any kind of subsidies or tax breaks or blah, blah, blah?
Sure, that would be, quote unquote, a clean figure, but I think at the same time, you'd have to back out then of anything else you compare this against. You'd have to back out any subsidies that are inherent there. Yeah. So what we haven't done is go through and do the same exercise of desubsidizing for gas, coal, et cetera, right?
To actually see what the cost of whatever it is.
Sure.
Okay, do we have one more question?
There was a time in the 80s when semiconductor chip manufacturing got out of balance.
Yep.
And it was actually trade policy that had the impact of raising memory prices. And do you worry that that could happen here, where anti-dumping legislation might come in, so that the forecast that you're seeing could be overridden by trade policy?
So in particular, if I could constrain the question, in the United States, let's say the United States puts up a protectionist policy, could then the price of solar modules increase? And I think that this is it's a concern, right? Anytime you put on a constraint on trade, certainly you would be exposed to the potential, if your manufacturing sector isn't as competitive as a global sector, that the costs internally will increase. And I think that there are cases around the world where there are restrictions on where the solar module must have come from, where that may be happening. And so there are, in particular, classes of policies known as domestic content requirements that attempt to tie the development of solar PV or any renewable technology to the growth of domestic industries. And anytime you put a constraint on, you'd expect that prices certainly won't decrease for that product, but they're unlikely, they may or may not increase. It depends on the level of competitiveness of your industry.
Okay, please join me in thanking our speaker.